talking to a lot of investors, they have to go to the boards and saying we cannot afford going for Spain or whatever because we cannot convince our board going for these kind of countries. But I think therefore the argument then is therefore we stick to countries like Germany, the Nordics or whatever. The funny thing with this, they are arguing with the stability of the Eurozone, and if you make this argument, at the end you can go nowhere than your home country, because if Spain theoretically will leave the Euro, the Eurozone will fall apart because the ECB won't be able to really stabilize the whole thing. So if you're afraid of a breakup of the Eurozone, the argument has to be, then I go nowhere except my home country. So I think not going for Spain just because of being afraid of the Euro from the investor side is a little bit not logical in the sense when you go to France and not to Spain. It doesn't make sense actually, because if Spain leaves France and the rest will also break apart, and then you will have the currency risks again no matter where you are. And Germany will be one of the few European countries where you see the currency going up, and therefore you can gain on value with all the other countries losing value. And I think that's a little bit from the investor side, not being an economist, not very logical on the one side, because you see the returns, as you correctly pointed out, and you see the big players, even German open-ended fund, moving back to Spain again because they realize, okay, maybe they also have big enough funds with more or less private public money, where they don't have to go back to an investment board to decide on what really to do at the end. And I think most of the institutional clients or of the German institutions will then go back to these kind of Mediterranean or fringe countries when they perceive the risk now is gone, but where also the opportunity is gone. Because you've seen this with Ireland a year ago. The US investors moved in tremendously to Ireland. They realized a lot of the values and the opportunities in these markets. And today, more and more, when you talk to investors, they think, okay, Ireland can be of interest, but you've lost at least 12 to 18 months of market movement. You're coming in when the story is finished, more or less. And I think that is what's happening a lot of the time to a lot of the I would say German-based core investors, because they're simply too afraid of taking the risk or being the first to move, which always leaves you in a position where you're not really having a lot of possibilities to exploit value-add opportunities. A year ago I said Ireland. I will still say look at Ireland, because I think there's something out there. You definitely have to look at the Mediterranean countries, because I believe there is opportunities on the Iberian Peninsula and in Italy, just looking at the pure fundamentals and what's happening. Because what can you lose if you go for city center Madrid offices or retail properties? If you don't believe in the Eurozone falling apart, what can you lose there? Okay. I don't understand the point. And the other thing you have, what Thilo correctly mentioned, you have a lot of opportunities out in the German market itself. You can diversify quite a lot depending on what you're doing in Germany, where are you investing in Germany, what type of properties you're going for. And I think that is also one of the things we have to learn, that diversification has not always to mean we have to grow abroad. We can look a lot within Germany or within the core European countries where we can diversify, because given the polycentric structure of Germany, there are different cycles in a lot of these markets. Nevertheless, the underlying fundamental is driven by the overall German economy. So they will move a little together, but there are opportunities, and you just have to be able to exploit them. You need the structure to do it, because you don't find them purely in Hamburg, Frankfurt and Munich.